Hello everyone, Darren here from Safety in the Market. Keep watching as I show you how simple short trading really is. We've done a few videos now and some of them have involved us wanting the market to head downwards instead of upwards, and that seems to have confused a few people, and we've had a few queries about short selling. So I just wanted to tackle that for you today. And here's the why. We've got a chart here of Apple, of the NASDAQ in the USA. It's a monthly bar chart. And as you can see here, this close here was December 2020. And the market makes its way up the stairs. And 4 years later, we find a current top in the market. And look what happens when the sellers get involved. Okay, we've had buyers all the way through here. Now, they need people to sell them shares. When they're buying for the market to go up, they need someone on the other side of that trade to sell them shares. But when there are more sellers in the market than buyers, we go down the elevator. And having taken 4 years to rise up to that level, we took just 4 months to come back down nearly 75% of that range. So money can be made faster on the way down than it can on the way up most of the time. You know, what is it? Like we said, you know, if you were trading here, you'd want Microsoft to head north, upwards. So you'd be buying to open your position. Okay, then you might sell at the top here to close your position. Well, short selling, we're just doing the opposite. We're selling to open here because we think the market is heading downwards. And then we buy to close that trade at a lower price. So your retailer on the high street is selling you t-shirts and shorts and jumpers and jeans every day. They haven't paid for those products yet, but they're selling them to you. Then they will buy them from their wholesaler at a later date, okay, at a lower price, depending on how many they've sold and how long it took them. So it's happening every day out there on the high street. So as you can see, we've sold 100 shares at $27, thinking the price is going to lower. Then we buy 100 shares to close out that position at $25, and we get a profit of $200 in the meantime. So when we're going long, when we want the market to go up, we're buying to opener positions. We're buying low and we're selling high to make a profit. When we're looking to short the market, we're selling to open a position. We're still selling high and buying low. Previously, we bought low and sold high. Now we're just selling high first and then buying low to finish. Okay, we've just changed the order, okay, with the broker. So what if it goes wrong? So what if we think a market is heading downwards and it doesn't? So here's a chart of the Commonwealth Bank, which is one of our major 4 banks in Australia. So we might look to sell here. We will always use a stop loss in case, always. What if it goes wrong? Well, our stop loss will look after us. So here our students would have watched this market fall. As it retraced nearly 50%, they'd be thinking about shorting this market. So they would sell here at the breaking of this green bar to open a trade. And they'd be using this range to then gauge where to buy to close out that trade for a profit target down on this pink line. But they also will put in a buy order to close that trade up above this green bar as a stop loss, just in case the market goes up instead. We might just have a quick look at that here. Here we are. We've sold Commonwealth Bank here to open up a trade. We're looking to close down here. But while we're opening the trade, we have a buy order up here as a stop loss, just in case we're wrong. So we're either going to buy to close up here, or we're going to buy to close down here. So let's just watch as this trade opens up and heads down. So everything's looking good. As we can see, the market's starting to rise up now, and we're thinking, okay, maybe we're wrong. We're not going to get down to here, but our stop loss is going to save us from losing excess capital. That, our students may have already moved their buy order down to break even. So as we came up here, they might get themselves out at break even and not lose any money. The market's sideways currently. Okay, still got both our orders in, and there you go. So for the students who would have brought their stop down here to break even, they may have been taken out here. But if not, look what the market does on this day. It plunges down the elevator, it hits our profit target, and our buy order to close the trade kicks in, as does our buy order here. This will be cancelled also, and we will take our profits down there at 167.91. All right. Okay, so we'll head back inside. And just a quick summary. Buy and sell, they're just orders for the broker, and their roles can be reversed. Your platform won't care which one you hit first. Long means buy into open, short means sell into open. But if you enter with a sell order, you'll have to close that order and that position with a buy order. Short selling requires a bit of a deposit, which covers some of the risk, which is always called a margin. And as I said earlier, retailers do this on the high street every day of the week. So if you'd like to know how to short sell a little more, follow the link below to find out about the Active Trader program, the course that will teach you how to trade the markets long and short. Thanks, guys. See you soon.